It's 8 a.m. in Tokyo. A 65-year-old woman deposits her life savings into a Japanese bank. She earns 1% interest. It's 8 p.m. in New York. A 35-year-old hedge fund manager takes out a massive loan. From that exact same pool of money he pays 2% interest, he then invests that money in a U.S. Treasury bond paying 53%. This is the yen carry trade. It's a global ATM. It has been the free money machine funding our world for 30 years. And it has grown into a $20 trillion monster. Now that machine is starting to break. The unwind of this one trade could trigger a global asset sale nobody is prepared for. To understand what's about to happen, we have to go back to 1989. Japan was on top of the world. The Nikkei stock index was screaming towards 39,000 points. The land under the Imperial Palace in Tokyo was worth more than all the real estate in California. It was the biggest financial bubble in human history, and then it burst. The crash wasn't a dip. It was a 30-year depression. They call it the lost decade. Stocks, real estate, everything collapsed. The Bank of Japan Boyage had only one weapon to fight this: deflation. Interest rates. They cut them from 6% to 4% to 2%. It didn't work, so in 1999 they did the unthinkable. They cut interest rates to 0%. Revelation number 1. 2 o'clock min mark. For the first time in modern history, money was free. They broke the seal. And they never looked back. For most of the last 25 years, Japan's interest rate has been 0 or even negative 1%. They paid you to borrow. This policy failed to fix Japan's economy, but it created a new accidental product. The cheapest, most abundant loan on planet Earth. The world's investors took notice, and the carry trade was born. So what is it? Here's the simple version. Step 1. Borrow money in a currency with low interest rates, the yen. Step 2. Sell those yen and buy a currency with high interest rates, the US dollar. Step 3. Invest those dollars in a high-yield asset like a US stock or bond. Step 4. Pocket the difference, which is called the carry. Let's run the numbers. I'm a hedge fund. I borrow 10 billion yen at a cost of 1%. I convert it to $66 million USD at 150 yen to dollar. I buy a 10-year US Treasury note paying 45%. My cost to borrow is 1%. My return on the bond is 45%. My profit is 44%. On $66 million, that is $29 million in profit, and I did nothing. I just moved money from column A to column B. It is the ultimate risk-free trade. But it's not just hedge funds. Big banks do it. Insurance companies do it. Even Japanese retail investors, the Mrs. Watanabe, do it. They borrow from their own country at 0% to invest in America. But here's where it gets interesting. This has been going on for 30 years. Where did all that money go? It didn't just buy US bonds. It bought Australian real estate. It bought Brazilian stocks. It bought private equity. It bought European corporate debt. That 0% yen loan became the hidden funding source for everything. It's the silent leverage propping up global asset prices. When you see the S&P 500 hit a new all-time high, you are seeing the yen carry trade at work. So how big is it? Revelation number 250 min mark. Here's the problem. Nobody knows. It doesn't trade on an exchange. It's hidden inside private derivative contracts and bank balance sheets. It is a shadow system. Estimates from global strategists put the total size of this trade between $10 trillion and $20 trillion. Let's put $20 trillion in perspective. It's larger than the entire annual GDP of the United States. It's 10 times the size of Apple. It's a $20 trillion bet, all placed on one side of the boat. A boat that assumes one thing will never happen, that Japan's interest rates will never go up. This boat has almost capsized before it happened in 2008. Before the crash, the carry trade was booming. Investors borrowed yen to buy risky assets like US subprime mortgage bundles. Then Bear Stearns failed. Lehman Brothers collapsed. Suddenly investors didn't want risk, they wanted safety. It was a global risk-off panic. Everyone tried to unwind the trade at the same time. They sold their toxic assets. They took the US dollars and rushed to buy back Japanese yen to pay off their loans. What happens when everyone buys yen at once? The price of the yen skyrockets. In 7 months, the yen strengthened from 110 USD to 87 USD. It surged 21%. This amplified the 2008 crash. It was a global margin call. But then the world's central banks did something incredible. The US Federal Reserve, the European Central Bank, the Bank of England, they all cut their interest rates to 0%. They all became Japan. This bizarrely saved the carry trade. The profit difference vanished. The trade went dormant, but it didn't go away. After 2008, the entire world lived on 0% interest for 12 years. This was the everything bubble. Stocks only went up, real estate only went up, and the cheapest loan was still the Japanese yen. So the trade slowly rebuilt itself, bigger, quieter, more leverage. It fueled the 12-year bull market. That ended in 2021, and then everything changed. Revelation number 380MIN. Mark two letters, INFLATION. Inflation running at 2% spiked to over 91% in the US. The US Federal Reserve had to act. They launched the fastest interest rate hiking cycle in 40 years. They raised rates from 25% to 525%. In just 18 months, while the US hiked, Japan did nothing. The Bank of Japan held its rate at negative 1%, and the free money machine went into overdrive. The difference between US rates and Japanese rates, the carry, became the widest it has ever been. It wasn't just a good trade, it was the only trade. Everyone on Wall Street piled in. This created a massive, dangerous imbalance. So many people sold yen to buy dollars that the yen's value collapsed. It fell from 115 USD in early 2022 to 130 to 140 to 151 USD by October 2023, a 30% crash in the world's third largest currency for the hedge funds. This was a bonus. Their US assets were now worth more in yen terms, but for Japan it was a disaster. A weak yen means the cost of everything they import, like 90% of their energy and 60% of their food, explodes. Gasoline prices spiked. Food prices rose for 24 straight months. The Japanese people are getting poorer. Public approval for the government fell to 21%. The Bank of Japan is now trapped. They are finally being forced to raise rates for the first time in 17 years, and this is the pin that will pop the $20 trillion bubble. The unwind of this trade has two triggers. They are both about to be pulled. Trigger number 1, the Bank of Japan hikes. The voyage has already ended. Negative rates moving to 1%. The market expects the next hike to 25%, then 5%. These numbers sound tiny, but they are not tiny. To a hedge fund leveraged 100 to 1, a hike from 1% to 5% quintuples the cost of funding the trade. The free money is no longer free. The carry shrinks. The first investors will start to sell their US assets to close their loans. This is the slow, orderly unwind. But there is a second trigger. This one is not orderly. Trigger number 2. The yen strengthens. This is the real killer. This is the one that causes the margin calls. Let's run the numbers on the trap. You borrowed 150 million yen a year ago. When the rate was 150 per US, that cost you $1 million USD. You invested that $1 million in the S&P 500. You're happy, but today the Bank of Japan hikes rates, or the US Fed cuts rates. The currency market panics. The yen strengthens violently from 150 USD to 120 USD. Just 20%. Your $1 million in S&P 500 stocks is still worth $1 million. But your 150 million yen loan is now worth $125 million USD. You are down to $150,000, not because your stock went down, but because the currency moved against you. You have a margin call. You must sell your stocks, not because you want to, but because you have to now multiply that one margin call by all $20 trillion in the trade. The first fund that has to sell its US stocks must buy yen to do it. That buying makes the yen stronger, which moves the exchange rate from 120 USD to 115 USD. This makes the currency losses worse for everyone else, which triggers more margin calls, which forces more selling of US stocks, which forces more buying of yen, which makes the yen stronger again. It is a positive feedback loop, a currency death spiral. It's not a slow leak, it is a dam breaking. This isn't a stock market crash, it's an everything crash. The DOW, the Nasdaq, Bitcoin, Australian housing, everything that was bought with cheap yen will be sold at the same time. 2008 was a crisis of credit. The loans themselves were bad. This is a crisis of funding. The money that bought all the good assets suddenly and violently disappears, which brings us back to today. The Bank of Japan is trapped. If they don't hike rates, the yen hyperinflates and their society collapses. If they do hike rates, they save their currency, but they blow up the $20 trillion carry trade and the entire global market. They have no good options. The unwind has already begun. The yen has strengthened from 151 USD to 140 USD. That's the first tremor. The question is, what causes the main earthquake? Which trigger fires first? Will it be the Bank of Japan hiking rates to fight their inflation? Or will it be the US Fed cutting rates first as the US economy slows down? Both of them cause the yen to spike. Both of them start the margin calls. Drop your prediction in the comments below. Which is it? BOJ hikes or Fed cuts? Subscribe to the channel. We'll be tracking this currency pair. And this $20 trillion risk every single week.